CU Practice Test 2026 Certified Underwriter Underwriting Insurance Mortgage Exam Questions Prep. Question 1. What does LTV stand for in underwriting? Loan to value, liability to verification, long-term value, loss to volume. LTV measures the ratio of the loan amount to the property value. Question 2. A high debt-to-income (DTI) ratio usually indicates lower risk, higher risk of default, a large savings account, excellent credit. High debt relative to income makes it harder to meet obligations. Question 3. Which of the following is an example of an adverse selection risk? Insuring only healthy people, a person with a high-risk hobby seeking life insurance, a person with a safe driving record, a standard homeowner. Adverse selection occurs when high-risk individuals are more likely to seek insurance. Question 4. The primary role of an underwriter is to sell insurance policies, evaluate and price risk, repair damaged property, market company brands. Underwriters decide whether to accept a risk and at what price. Question 5. What is moral hazard? A natural disaster, dishonesty or lack of care by an insured person because they have insurance, a mistake in the paperwork, an ethical business practice. Insured parties may act more recklessly if they know they are covered. Question 6. In mortgage underwriting, private mortgage insurance (PMI) is typically required if the LTV is below 80%, the LTV is above 80%, the borrower has a high income, the house is made of brick. PMI protects the lender when the down payment is less than 20%. Question 7. What are the 3 Cs of underwriting? Capacity, capital, character, cost, coverage, claims, credit, cash, collateral, compliance, care, control. These are the traditional pillars of risk assessment. Question 8. A binder in insurance is a folder for papers, a temporary agreement providing coverage before the policy is issued, a final contract, a rejection letter. Binders offer immediate, temporary proof of insurance. Question 9. What does underwriting profit refer to? The money earned from stock investments, premiums collected minus claims and expenses, the CEO's bonus, the interest on loans. It is the profit from the core insurance operations. Question 10. An escrow account in a mortgage is used for paying the realtor, collecting funds for property taxes and insurance, storing the house keys, reducing the interest rate. Lenders use escrow to ensure taxes and insurance are paid. Question 11. Which document provides a summary of the applicant's credit history? Income statement, credit report, title search, appraisal. Credit reports from bureaus like Experian, Equifax/TransUnion are vital. Question 12. Capacity in underwriting refers to the size of the house, the borrower's ability to repay the loan based on income, the volume of the fuel tank, the number of employees. Capacity is about cash flow and debt obligations. Question 13. What is an insurable interest? A curiosity about insurance, a financial stake in the subject of insurance, the interest rate on a policy, a legal fee. You must suffer a loss to be eligible to insure something. Question 14. A retrocession occurs when an insurer raises rates, a reinsurer passes part of its risk to another reinsurer, a claim is denied, a policy is cancelled. Retrocession is reinsurance for reinsurers. Question 15. What is manual underwriting? Using a physical book only, a process where a human reviews the application instead of an automated system, writing the policy by hand, repairing a car manually. Manual review is used for complex or borderline cases. Question 16. The spread of risk principle suggests insuring only one large building, insuring a large number of diverse risks to minimize impact of any one loss, charging everyone the same price, ignoring small claims. Diversification is the foundation of insurance. Question 17. Which factor is most likely to cause an underwriting decline for a mortgage? A high credit score, unstable employment history, a large down payment, living in a quiet neighborhood. Unstable income is a major red flag for lenders. Question 18. Substandard risk refers to a risk that is better than average, a risk that does not meet standard requirements and requires higher premiums, an illegal activity, a risk with no potential for loss. Substandard risks are accepted but at a higher cost. Question 19. What is the purpose of an appraisal? To verify the borrower's identity, to determine the market value of the property, to check the plumbing, to calculate the tax rate. Appraisals ensure the collateral supports the loan amount. Question 20. Which regulator oversees insurance at the state level in the U.S.? SEC, State Department of Insurance, IRS, FBI. In the U.S., insurance is primarily regulated by individual states.